All right. Welcome to the podcast, everybody. Today is August 25th, 2022. Welcome to the podcast. In this episode, we're going to be talking about student debt forgiveness that was just released or announced yesterday by the White House, and how that impacts the inflation calculation and what this means for investors. Second topic is, right now the economy doesn't look so good. I just get a feeling that something's about to break. What stocks should you be buying, or should you be buying at all? And then the third is Nvidia. Nvidia is a company that we talked about previously. They're a great company, makes GPUs. That's their specialty. They just announced their earnings. So let's do a deep dive into that company. All right, let's get going. So, all right, stocks. All right, before we talk about what stocks people should be buying or not, let's talk about the student debt forgiveness program. Student debt forgiveness program that was just released.
Yeah, I think most people outside of the U.S. may not know what's going on here, but I think the student loans has ballooned to like $2 trillion in debt across the nation, and the Biden administration has campaigned on this promise like a year and a half ago, 2 years ago, saying that they would eliminate some amount of student loan debt for people, and I think the average amount of student loan debt people had was like somewhere between $20,000 and $30,000. It may be a little less than that, but so they were essentially cutting their debt in half and granting people a loan forgiveness of about $10,000. So for those of you who don't know all of the mechanics of that, like if you pay your student loans on time, I think after 25 years, the government essentially forgives your loans, or 20 years. They are now offering this like even to people who just graduated from college like a year ago. So it's basically just income based. So if you make less than $125,000 as an individual or $250,000 as a family, you are eligible for that. So this actually applies to a lot of people who are temporarily, like I would have fit that category at some point, where I was a resident making, $40,000 a year and could have gotten student loan forgiveness, even though as a physician, my salary could have been, would be much higher, later after I finished my training. So as you can imagine, what that does is it's going to cost the U.S., it's basically spending $300 billion, right, is what it's going to cost the U.S. in year one. And if they do it again, year two, it'll be even higher, is the estimate. So, this is not like everybody looks at it and says this is like a win, for people. But when you actually break down the numbers, this impacts disproportionately people in the higher socioeconomic group. It has very little impact on low income people because they typically don't even have student loans, right?
Yeah. I'm just looking at student debt. I'm just thinking about the mechanics of this, right? So the U.S. government. So who actually holds the bag, and how are they able to just like straight up just cancel that money? How does it actually work?
Yeah, it's what happens is in the early 2000s, the Bush administration converted student loans from privately backed, like your normal bank was issuing student loans at an interest rate that was tied to prevailing market conditions. It got converted to a government run loan and managed and serviced. Um, and all of the loans that were through that program came in at, um, a fixed interest rate of like 6% or something like that. And so the government then has authority to, through the Department of Education, has authority to, I guess, forgive these. I'm not a lawyer here, but um, since it's a government loan, really what is happening is we, the people of the United States, are issuing the loan to individuals, and then we are essentially writing off their loan. Like, I'm not getting paid back for the loan I issued, essentially, right? And it's not what I asked for, right? And this is all in the context of, we passed that Inflation Reduction Act, which was supposed to save $300 billion, and now you just say, well, we're going to spend 300 billion more, right? That's effectively what it means.
Yeah, I think we can take it a couple different directions. I think I've heard on an individual level. I think it's important to look at it from both sides, right? It's like I think for me at least, I think it's the same for you. I think it's easy to look at this and say, what injustice, like people who, you know, there was that video going around on Twitter about of this dad who saved and saved and saved and paid off her daughter's student loan while he was complaining to Elizabeth Warren that, do I get my money back, because my friend over there who makes more money than he didn't do the right thing and saved and paid down the loan. In fact, he actually borrowed like I did for a student loan and then went on vacations. He never actually paid the money back, and now he's going to get forgiven. What kind of injustice is that? There was this confrontational moment that was captured on video. I thought it sort of captured the essence of a lot of the fury that people might feel about this program, right? This sense of injustice. I think it's easy to see that. I think also it is also easy to see the other side, which is that, like, if you take a charitable view on this, which is that, okay, like people are saddled with all this debt and they can't really be productive because they're just busy servicing these debt. And it's sort of like it's hampering them from going out and, I don't know, spending more in the market. I think that's the charitable view. My take on this is that, like, is this at the moment in time right now completely, is this necessary? And I also think about it in this way. Like in the past with COVID, like government spending generally, I don't think is categorically bad. I think there is good government debt, and then there's like really bad government debt. Good government debt is like, if you actually use debt to finance some of these projects that ultimately lead to higher productivity. I think that could be I think that is a way that government can step in and actually become good and really increase the productivity. Bad debt, on the other hand, is just what happened in the last 2 weeks, or what happened in the last 2-3 years. Like COVID crisis hits, everyone gets used to the gills with all these stimulus checks. What is that? Where is that money going to? Is it actually going to increasing productivity overall, or is it just going to meme stocks? And I think we know the answer. And I think I'm afraid that this also is sort of falling in the second bucket. Like, is this like the Eisenhower Highway, like this increasing the productivity of the country? I don't think this is going to really move the needle. So that's my take on this. And on top of that, you have the inflation pressure. It's just not helping. I'm not sure what's going on. Like, it feels like, are we gonna just let the printer go burr and just monetize away all the debt that we have, so that inflation number just keeps running? And so let's keep this train going for another 3-4 years, and by the end of that, we're going to have massive inflation, but in relative terms, because the dollar is so much weaker, or the paper money is much less valuable at that point, the debt becomes less to percentage wise much more smaller to GDP. I don't know. I don't know I don't know if there's any plan behind this, but at the moment, I feel that this was a mistake.
Well, I think one of the things that we have to look at as a society is we are spending an inordinate amount of money on college, right? And when I went to school, my entire tuition, just my tuition, not my room and board, was less than $2,000, right? And if you talk to most people in, prior to like the early 2000s, they were paying between $500 to $2,000, and they could work. In college, they could work and pay off their pay for their tuition and room and board and live, and they would come out with maybe minimal debt or no debt, right? And instead, we've now, as we've added more freely giving loans to people, all colleges have done is, well, if the government's going to pay for it, I'm just going to raise my prices, right? And so that's essentially what has happened is now my same school, University of Texas, is around $10,000 a year, which is still, relatively reasonable considering, but some schools are, $40,000 a year, $50,000 a year. And when you consider that like a 4-year program, you're taking on like $200,000 in debt, what value are you providing? Like, are you gaining from that? Right. So, I mean, just thinking about it from our podcast standpoint, right? Like, there's a price and there's value, right? Like if I go to school because I'm going to medical school, that's a reason to go to to go to college, right? Like I can't do that just by, tackling people and practicing medicine on them, right? Like I have to actually go to school for that, right? But if you're a programmer or you're do you really need to go to college for that kind of stuff, right? Where is the value in spending $50,000 a year to basically, bum around, drink too much alcohol, find yourself, and then, end up
Find yourself.
Like
Hilarious.
It's not. I mean, it's not really like. I don't think that's a valuable thing for somebody like 18 to 22 years old, right?
Yeah, I mean, I think the point that we should really touch on is like how expensive this whole thing became over the last 20 years. And let me just flash a chart really quick because I think this is is there a way to do this here on the platform? I think there is. Okay, here we go. All right. Can you guys see this? I think you can.
Yep.
Okay, so this graph, I think, tells so much about what's actually happening. Inflation, it's a basket of things. Inflation, if you don't aspire for a good healthcare, good education, good housing, if you just want to watch television and have a phone service and live in your mom's basement, like inflation is actually not hitting you very hard, right? It's not hitting you very hard. But if you aspire for college, if you aspire for higher education, if you aspire for good healthcare system, it's been really expensive. I mean, look at that chart up there.
Yeah.
And we can talk about why is it like what is the cost driver for all these things that are going up through the roof? We can talk about that some other time, but I think this is just an important chart to keep in mind is that okay, some of these programs that we're now coming in and forgiving, they're incredibly inflated, and this is kind of similar to what we talked about in the previous episodes when we said, oh, look, the government is going to give you $8,000 in the EV credit, and then all of a sudden, a couple weeks later, Ford turns around and raises their EV F-150 sticker price.
I mean, and honestly,
this is exactly what's going to happen to colleges. They're going to turn around and say, "Oh, let's raise the tuition $10K," and it's just going to contribute to this graph. It's hilarious.
Well, and I think the thing is that as a society, you have to actually hold, like, if you get a job if you get a degree in petroleum engineering, right, maybe it's worth paying $100,000 in student, or getting a loan in student, $100,000, because your average salary is going to be like 100K when you come out, and tops out at like, median, like after 10 years, about like 180,000. So if you can get a job making that kind of money, then it makes perfect sense, right? But I mean, if you're getting a job in, basket weaving, then what's the point of, and your salary is going to top out at $30,000. Why should I give you a loan for 100K, right? Because that major doesn't warrant the long-term, value of this. So, I mean, I think that's, we can go on about this forever, but to me, this is just, it's pandering to your base and trying to get people to vote for you, and not really benefiting the American society. And I think there are a lot of people who are going to, who never took out student loans, who are very responsible and paid off their loans, that this is a slap in the face to them. So,
Yeah. Let's move on. Okay. Let's move on to the next topic, which is the title of the podcast. What stocks should you be buying right now?
So, what I wanted to kind of talk about is, with this topic here, is kind of making sure that we have like, getting back to our original roots on this podcast of, like, if I were to design an ideal business, right, that I want to own, I want to have, like, what are the criteria that I would want to own, for this kind of market right now. Okay. And the way I look at it is, I want to have a business that has the ability to raise prices, right, to match inflation, like, so that I can, but without having it impact my sales, right? That would be, I think, number one. I would want a business that doesn't have an enormous amount of debt that would, impact me in, if they have to refinance at a higher interest rate, which, because interest rates have all gone up. I would want a business that has an, adequate amount of cash flow that would, that they could either return to me or put back into the business, at an above average rate, right? So a highly profitable business, like a return on capital of north of 20%. And, I would want a business that's run by a company that, or by management that has, that has my shareholder interest, at heart, right? So, I mean, do you have
Can I
anything
pause
to
you
add
for
to
a
that?
second?
Yeah.
I would say out of those, the one that the two things that resonate with me the most is number one and number two. The ability to raise prices, and then their balance sheet is managed so that they're not paying out of their ass for interest payments. I would say those two things would be like the top two priority for me if I were looking at some of these companies.
Yep.
Because in the environment of sort of like the stagflation that we're sort of entering into, right? If you can't raise prices above inflation or to meet the inflation, you're going to get, I mean, it's going to be a very difficult time.
Yep.
And then also, because the interest rate is going up to tame inflation, if the interest rate goes up and you have, a mix of variable and fixed interest, but you have exorbitant amount of debt on your balance sheet, you're going to be spending a ton of cash just to finance those debt, and that's not going to be good for the business. In the low interest times, it was all good. Like, it was no problem. The cost capital was so cheap, like, no problem. But the period that that we find ourselves in right now, I would say those two things are sort of paramount. So if you are looking at a company that doesn't check those two things off, I would say really, really think twice about it. Again, not financial advice, but I think those would be shrewd to really think about.
Well, of those four things, though, what is interesting to me about them is they're exactly the same things I would expect in a low inflation environment, right? I would want a business that has the ability to raise its prices if, because even in a non-inflationary environment, your supply uh, costs may go up for some reason because of, some shortage of food or whatever, right? I would still want a business that has the, capable management that is going to look after my shareholder interests, that pays, has a large amount of free cash flow relative to its price, right? Um, you know, all of those things are things that I want in a business, regardless of the outcome, and I think, or the macro environment. And I think if people forget, like, if you look at Motley Fool or Seeking Alpha, or it's always 10 stocks to buy in this environment, or 10 stocks to buy right now, or whatever. But the reality is, it's a great business. The macro environment really doesn't matter, right? In a great business, what you're really buying is something that has a large moat that can protect it in almost any environment, right? Not no business is going to survive in every environment, right? Uh, but you want it to be able to survive almost every environment, and that's like Walmart is not going to go away, right? Because it has, it's basically in every city in the country, and it has the ability to raise prices to because people have to shop, they have to buy groceries, they have to buy the things that they need, right? So it's always going to succeed in any environment, right? um, and and that means that you want businesses like that in your portfolio, because um, it's going to only protect you in the long run, right? Like, over the long haul, those businesses are going to beat the market, and that's what you should really be shooting for when you invest in anything, right? Is evaluating that in that lens.
Hmm. Yeah. So let's speaking of which what stocks you should be looking for. Before we jumped onto the podcast, we said maybe we should look at Nvidia. So how does Nvidia? We did a whole podcast on Nvidia maybe a couple years ago. How does Nvidia meet that criteria, you think?
So Nvidia is a very interesting business because for the last 3 or 4 years, they've been riding high on the crypto craze. So their GPUs were being bought in droves by people who were doing mining operations and things like that to create crypto. Um, and then when the crypto crash happened, people stopped buying it. And if you were buying a GPU just for your game PC, I mean, people were spending well over retail price to get it. Um, and so now what we see is Q2. They just announced their Q2 earnings here recently, and their gross margin actually dropped from 67% to 46%, which, if you remember, the gross margin is the revenue minus the cost of goods sold. Um, you know, and then you divide that gross profit divided by revenue, right? So essentially, they lost 20 percentage points were lost, and it was largely because they had to discount the prices of their GPUs because no one was buying them right at that price. So they essentially dropped price. So on the surface, that sounds like we're talking about they couldn't raise prices in an inflationary environment, right? But their problem is not that, right? I don't want people to confuse that. Their problem is that they had, for a long time, huge demand. The demand has now decreased. They've got to move on to the next model of things to start selling, so that attract the next round of gamers to come and purchase, right? um, the other part of it is, their operating expenses kind of went up at the same time. they grew heavily at the same time to for R&D purposes and things like that. So it really killed their earnings per share. But when you think about it from a perspective of, there's nobody else that's competing with them. AMD makes the Radeon line of cards, and gamers pretty much universally prefer the Nvidia ones because they're better, more features, that kind of stuff. So they have essentially a monopoly on this. I think their long-term prospects are going to be fantastic, right? So it's now just a matter of, is it priced correctly, right? For purchase.
Mm-hmm. Let me quickly share my screen here again, and then we can walk through the numbers really quick. For those of you who don't know, this is our database. It is currently open for anyone to use. Just go to valueinvestor.org. That URL might change, but have a look at it. We just typed in the ticker. Okay, so let's see. This is just on an annual basis, so it doesn't have the most recent quarter. But you can see this is the top line, total revenue. Let's look at total revenue from the last couple of years. It's been insane. Like, I mean, they doubled. I mean, this is, the crypto craze.
2.5 times from 11 to 26.
Yeah. So it grew. What I would like to, so two things, right? Or I guess, two things at least that I think about is, okay, are they able to raise prices, number one, and do they have a reasonable balance sheet? So the balance sheet portion of it, so if you look at the debt portion of it, there's about $12 billion of debt. And having debt is just, it's not bad categorically. We just need to, it just needs to be right sized. So they have $12 billion in debt. Cash, they have $2 billion. But if you look at their cash flow from operation, free cash flow, $8 billion. And then these are numbers from 2022. I'm not sure when they reported this, but those are some numbers. So in terms of the balance sheet, I would need to do a further deep dive on this, but it looks pretty healthy compared to. I think I would like the debt to be a little lower, but assuming that they got it at a very low rate back in 2022, and the free cash flow is enough to cover that. Yeah. And then net income, yeah, they've been growing. Are they doing any stock buybacks? No. Same.
Yep.
They don't pay out any dividend, or do they? They do.
It's small, but I think the larger point with that is since they're still growing heavily, I would rather they reinvest that profit back into the business to have future growth. And they hit on, when crypto was going nuts, they were really nailing it, right?
Yeah.
And so you benefited from that, from a management that was able to take advantage of that opportunity. So, to me, I think Nvidia is one of those businesses it's a great business. It's not necessarily at a great price right now, but you've got to kind of pay attention to its valuation and then pay attention to, what's happening and strike when the iron is hot, right? So, looking at your entire portfolio and investing and evaluating every business with those questions that we just talked about in the last segment is everything to how you do how you evaluate your portfolio. And it doesn't change whether you're investing now or 3 years from now in a less inflationary environment, right? It's going to be the same reasons that you would want to buy.
Yeah, it makes sense. Just one more thing on Nvidia, because like you said, this company is is pretty fantastic. I think there is a lot of opportunity for this company to grow into something even bigger. It's already quite a sizable company, but in the domain of graphics card, it's a premier company. There is no second best. I mean, if it's almost like monopoly, duopoly, I suppose. With one being more dominant, sort of like the card, like Visa and Mastercard sort of situation. If I just want to mention one more thing about this company, which is the founder mentality. The founder mentality. I think this is really important to kind of nail home. Is if you look at companies that really run really well over long duration, it's often that the founder or somebody with like big, lots of skin in the game is still around and
Yep.
actually running stuff. And
Yeah.
it's so important because companies that you and I like, they all have this characteristic, which is that founder that started the company or took over and has a lot of stake, skin in the game, influences the direction of the company. Because if you're a hired gun, your job is to sort of like run it for like a set period of time, and then I don't know, off to the next one. This Nvidia, the CEO there, he's a founder. I think he owns, a company this size. He owns maybe like 2-3%. Don't quote me on that, but 2-3% of the company of a multi-hundred-billion-dollar company. That's cool. Still a very sizable portion, and beyond just the financials. There is an emotional attachment to it because he started the company and founded the company. So there's a long-term strategic thinking behind. It's an easier bet, at least as an investor looking from outside in, if a founder is still with the company. That gives
Yep.
you a lot of reassurance that he's going to be thinking very long term and making the right moves. And so that's another thing that I think another kind of good point to think about, at least for me, when I think about Nvidia.
Yeah. I mean, it's a like we said, it's a good business, great business at a. It's the question is it a fair price? And that's the kind of thing you always have to evaluate with everything you're doing. And what we're trying to get to is really just telling you all the process never changes, right? You're always looking for the same things regardless of the macro environment. Like we've covered a lot of the macro stuff recently because it's very interesting and it's affected individual stocks, but for the most part, staying on track with what is the value, uh, what is the qualities of the business that allow it to succeed in any environment are the most important aspects of investments. So
Hmm. Yeah, great. I have yeah. We can talk about that some other time. We might actually we might do a deep dive on Nvidia again. I think there's some things that we need to pay attention to, sort of our new exogenous kind of forces that we didn't really consider when we did Nvidia as one of our podcast topics, such as the rising kind of fragmentation of the supply chain issues, the Taiwan, and Nvidia. I would say is one company that made me realize how freaking complicated this whole thing is. It's insanely complicated. The
yep,
supply chain issue. Everyone should just take a look at their 10K,
yep,
and you get to understand the scope and the just complete sophistication of everything that happens behind that. It's just and it's just insane level of coordination. Um, anyway, it could be a good topic to revisit soon. If you guys want, uh, drop that in the comment if you think that we should do NVIDIA next time for a deep dive. All right.
before we
Yeah, go ahead.
yeah, just before we get off the stream here, I want to make sure everybody remembers our Slack channel is available if you have any questions for us by emailing us at info@valueinvestor.org. And we'd really appreciate it if you liked, comment, and subscribed on the YouTube channel. That helps us with the algorithm, keeps us on our keeps the podcast growing. So we'd really appreciate that, because that'll help us keep this moving. And then I think, in the next few weeks, we should hopefully be able to announce some really big changes here. Do you have anything you want to add to that, Becco?
No, that's it. Nothing to add. Please like and subscribe, comment if you would like for us to review a company. Definitely write that down in the chat.
Yep.
We covered last week. We covered Nvidia.
Yep.
One of the listeners left us a comment there, so it does get looked at, and we do take those into consideration when we do our podcast. So definitely interact with us over comment with the comment section. All right. Thanks, everybody. Have a great Thursday. I'll see you guys next week.